questions. So if all of you can think of that why there is a component of interest, what could be the possible reasons? I would want, some of the answers from all of you, that what thoughts come to your mind, that why would an interest be payable? If you can, use your query handle and post your thoughts on that, it would be really helpful. Because for studying interest rate risk management, we must first be clear that what is interest. Good morning, Nakul. So why first of all interest? Then we will go to the techniques of, let's say, interest rate risk management, and our understanding would be stronger. If all of you can participate, it would be really good. Good morning, everyone. Okay, meanwhile, I think the responses would come. Let me put, there are broadly, two categories in which interest is paid. Okay, we have an answer from Mansha, which is time value of money. Great. So time value of money could be one of the reason. I'm just putting here two reasons, which at least I can think of. First of all, the first reason is risk of non-payment. Whenever someone lends money to another person, so there is a risk that whatever amount has been lent, the principal amount would not come back, or even the interest associated with that also would not come back. So there is a risk. There's a risk element of non-payment. Then second is actually inflation, or let's say time value of money. Correct? So second is inflation / time value of money, whichever way you can say. So to understand this, we all know that, let's say today, a common basket of good costs 100 rupees, right? This is 0 year. After 1 year, the same basket of goods would cost us, let's say, 120. So there is a 20% inflation here. 100 has gone up to 120. That means the currency, or let's say the currency has depreciated vis-a-vis the commodities. Correct? So there is a 20% depreciation, which is nothing but inflation, we can say. Depreciation in the currency, I'm saying. So 20% inflation, or the time value of money is getting deteriorated. Correct? So these are the two broad reasons why interest is paid. Good morning, Sanjay. Now there is a very important correlation to note here. If the risk is high, if the risk of non-payment is high, non-payment of both principal as well as interest, that means the default risk, or let's say the credit risk. So if the risk is high, someone would also charge interest also higher. Correct? Because that is the notion. Higher risk, higher reward. If I am lending someone some money and there is a risk of non-payment, I would expect higher interest or higher return to compensate for that risk. And similarly, if risk is lower, the interest rate that I would expect would also be lower. Generally, the risk of non-payment is actually governed by some of the credit rating agencies. If credit rating of any instrument is very strong, then the interest also would be very less. Why? Because the risk is very less. Hence, the expectation in market is, since the credit rating is very good, the risk of non-payment would be very low, and hence the interest rate would also be very low. which is the compensation for risk. So what we can understand from here is that interest is basically paid on account of two factors, or it's a composite for two elements. One is risk of non-payment, and second one is the inflation or time value of money. Whichever way you can think, all the reasons would be bucketed here. Now, next point is that interest is not static. Interest is always dynamic. Good morning, Kaushiki. Yes, Mansha. Whatever is the risk premium, the higher the risk premium, higher would be the interest. Okay. Now, as we discussed that, interest is dynamic. It is not static. Not static means it is not always constant. Interest will keep on changing. Why? Because the expectations, or let's say you can imagine it from the point of view of a price of an equity share, correct? The price of an equity share in a listed environment keeps on changing because there is a market, supply and demand. Similarly, for interest also, there is a market, supply of credit and demand of credit. That is where interest will keep on changing. And there are a lot of other factors. For example, governments also keeps on changing the interest rates. So hence, we can understand that interest is dynamic. If interest is dynamic, then don't you feel that whatever interest exposed assets or liabilities that we have as of now, there is a risk tomorrow that the value might go up or value might go down. And this can be beautifully, understand with this interest rate cycles. I'm just first of all talking about of an economy. If the economy is actually going up, there are chances that it might go into inflation, in good amount of inflation, correct? Because everything is growing with a good amount of scale. GDP is also growing at a very high level. So there are chances it might go into inflation. Once it goes into inflation, the interest rates would also be hiked by the government. Why? Because they want to control the liquidity in market, the credit in market. Because if the interest rate is higher, people will borrow less and spend also will automatically become less. Correct? So this will imply lower credit and hence lower demand in market. Correct? And it will help again in controlling the inflation. That is what the first interest rate cycle we can understand. So again, what is the key takeaway from this is that interest is again dynamic. That is what I'm trying to explain. Interest is dynamic. It is dependent on the market forces. It is also dependent on the government intervention to help the interest rate cycles. Now, on the contrary, if you see, if the economy is going down, there is a degrowth in economy, there is a chance that it might go into the falling inflation, we can say. Correct? Inflation would go down. Now, if the inflation would go down, government, what it will do? It will reduce the interest rates to make sure that there is enough supply of credit in the market. Correct? And people will use lower interest borrowings to spend more, and hence the economy growth will come back on track. Okay, students? Now here supply of credit, it will increase, and it is just to stimulate the market basically. Yes, Nakul is saying purchase power will go down. In first case, purchase power will go down. If the interest rate is increased, the purchase power will go down. Perfect. So students, with this, till here, what we understand is that interest is first of all paid because of two reasons. One is the risk of non-payment itself, which is also factored in the interest pricing. And second is the time value of money, because the rupee, or let's say the currency itself, is keeping on deteriorating. For to compensate that, there is inflation. Then we also understand that interest is not always, constant. I cannot say that 10% interest is always perpetuity. Interest is always dynamic. If today it is 10%, tomorrow it can be 11, or tomorrow it can be 9% also. And hence there is a risk. Correct? Then we also understood what are the interest rate cycles, which can again impact your interest rates. Now let's come to, so we have till now discussed all things about interest rate here. Correct. Now let's come to this term called risk. And then we will go to management, how to manage that risk. So first of all, let us try to understand that what is the risk in interest rate risk management. Okay. So in case of a risk, so interest rate risk, here we are talking about the risk from the point of interest rate. Okay. So the interest rate risk is the risk of changes in interest rate. Simple. If the interest rates are going to change, and this we already know because of two reasons, right? One is because of inflation, and second is because of the risk within that security, correct? So because of any reason, let's say the interest rate changes, it will constitute interest rate risk. And let us demonstrate how. Because if we know that, let's say this is a balance sheet. I'm just using the old format of balance sheet and P&L. Okay. So in case of balance sheet, you will have assets and liabilities, right? Let's say here are assets, here are liabilities and equities, and you have expenses here and you have income here. Okay. Now, some of these assets and some of these liabilities, in case the interest goes up or down, the value will change. Okay. Because let's say, imagine some kind of investments in the balance sheet of a company. And those investments, let's say those investments are in bonds. Once interest rate goes up, the bonds value will come down, correct? Because the bonds would be seen as, that all of you would have studied in your previous sessions, that interest is inversely proportional to the bond prices. So it will have an impact on the valuation of assets and liabilities. Similarly, if you have some finance cost and finance income here, finance cost / income, it will impact your P&L also, correct? Because imagine that you have a floating rate loan on which you are earning income. In that case, the income would go up or down basis the changes in the interest rate. I hope the impact, all of you are able to see the impact, correct? So what I am telling here is, in case of changes in interest rates, liabilities and assets value will also change, and some of your expenses and income will also change, which is related to that interest. Okay. So this is the risk that we are talking about. So Mansha is asking what to do in hyperinflation economy, increase rates. Yes, Mansha, that is what we are seeing. For example, in Argentina, Argentina is a hyperinflation economy. So the government there actually tries to increase the interest rates in line with whatever is the inflation. Generally, inflation in those economies is almost 100%. Okay. So they will also keep on increasing the interest rates there, so that your investments will also earn interest rate of almost 100% per annum, because the inflation is also 100% per annum. So what I'm trying to say is that the interest rate risk is basically the changes in interest rate, and it will impact both your balance sheet and P&L in some form or the other. Whether you are a banking corporation or whether you are not a non-banking corporation, everywhere it has an impact. Okay. So this is what the interest rate risk is. Now let us try to understand what are the different types of interest rate risks. Then we will go to the management of interest rate risk. Correct? That is very interesting. And let me tell you, this topic, this entire topic is very relevant from the practical life, because there are n number of instances that are happening around the world these days, because all of you might be aware that interest rate cycles are going for a toss, because US, their central bank, which is US Treasury, they are increasing the interest rates like crazy. Even RBI is also increasing the interest rates. Correct. So these all things become very relevant to understand the overall impact and how to mitigate that impact, which is the management. So type of interest rate risks. Okay. So first risk, or let's say the first type of interest rate risk that is given is gap exposure. Okay. Now let's take a bank's balance sheet. This is a balance sheet of bank. Because to understand gap exposure, let us step one step back, and let us try to see. These are assets. Again, these are equities and liabilities. Pardon me because I am still using T form. Okay. Just to make it clear. So whatever you can see in your bank's assets, students, please post in your query handle. Meanwhile, I am also writing whatever I know. Then we will also put whatever thoughts comes from all of you. So typically in a bank's balance sheet, under the asset side, you can see mortgage loans. Mortgage loans means typically housing loans, or let's say any other loan under which mortgage is given to the bank. That means secured loans, because these are the loans that banks have given. These are generally of 15 to 25 years. These are long term, right? Housing loans are generally like that. Then it might also have some sort of investments. Then it might also have some sort of physical assets. Let's say the land, building, right? Furniture, fixtures, all those things. Then because there is a strict statutory requirement, it would have some cash with RBI also, Reserve Bank of India. It will also have some, credit card receivables. Whatever credit card this bank has issued, it has some receivable from the people who have used those credit cards. It will also have, let's say, a car loan. This is generally shorter in period, 2 to 5 years. Correct? Car loan is shorter in period. Then again, some statutory, let me see. Yes, Mansha, UK is facing recession now. Why UK keep increasing interest rate? No, so actually we again are not reading economics in this session. So we don't know, and we are not also not experts to say whether it is recession or inflation. Correct? But they are actually increasing the interest rates to keep the increasing prices at minimum. Nakul, yes, we will discuss, we will touch some of these topics while we will study the interest rate futures. Okay. So coming back to this, I actually asked this question, what all you can think that will come under equity, liability and assets for a bank. So I would appreciate if every one of you can, respond to that. Then there are car loans. There is SLR. There is CRR. Correct. These are some of the other reserves that bank has to maintain. In form, I'm saying the form in which SLR is maintained, let's say in cash form or in cash and cash equivalents form, with that extent. Equity and liabilities, we all know, first of all, there will be some equity. There can be some borrowings. Correct? Because bank will also need some borrowings. There can be some deposits. Let's say fixed deposit, recurring deposit that we all know. This is RD, because bank accepts these deposits from people like us and even from corporates also. Then there will be all the savings accounts, money that will be there, that will also be coming on the liability side. Yes, Kaushiki, cash from RBI, cash to RBI, Mansha, borrowing from public RBI. Perfect. So I think mostly I have covered major heads. Correct. Now I want all of us to understand that any instrument, or let's say any asset or any liability, will always have two implications, or let's say can always be expressed in two forms, whether it has a floating interest rate or it has a fixed interest rate. Correct. Let's say borrowing can either have floating or it can have fixed. Correct. By floating I mean it would be linked to some sort of a market benchmark. I hope it is clear. Now just to give an example, for example, SBI, when it gives loans, so it will take the basic lending rate plus some spread on that to give the floating rate. Now, whenever the basic lending rate of RBI changes, automatically that increase or decrease will be part of the interest. That is called as floating. Fixed means bank will say, okay, I will pay you 3% on your FD, fixed deposit. That is fixed. 3% till 1 year, whatever FD you make, you will get only 3%, irrespective of whatever is the interest rate changes happens. Now, what I'm doing is I'm just putting that whether this is fixed or floating. Generally, mortgage loans, since these are higher tenure loans, these are always floating. Correct? Because bank would want to minimize the exposure. It will say that I am giving someone money for 25 years. What if tomorrow itself, or let's say, what if 1 year after from now, the interest rate changes? So I will not take any risk. I will keep it floating. If it changes, I will take the changed amount, the changed interest from the customer. Investments, it can be both. Some investments can be floating, some investments can be fixed. Physical assets, it has no implication actually. So, but hence I'm saying it is fixed only. Cash with RBI is always fixed because I don't know whether some interest is paid or not, but I don't know that. Even this credit card receivable is also some kind of fixed because they say that if you don't pay by time, you will be levied an interest of 24% per annum, something like that. I'm assuming it is fixed. Car loan, since car loan is given for a shorter period, generally bank gives it on a fixed interest rate. They don't link it to the floating cycle. Okay. Then SLR, CRR again, assuming fixed. Equity, there is NA. Borrowings can again be both. It can be floating also, and it can be fixed also. Fixed deposit is always fixed. RD is mostly fixed. Correct. Savings account is also fixed. Sometimes bank will change the savings rate for all the depositors put together, but it is largely fixed. Now, what is this gap exposure? Coming back to gap exposure. Gap exposure tells us to see the balance sheet of anyone where you're trying to evaluate the gap. It can be for a public company, it can be for a private company, it can be for a bank, it can be for a non-bank, it can be also even for the economy. Because in economy also you will have certain assets and certain liabilities which are fixed and floating. So while assuming the gap exposure, you have to identify assets and liabilities which have floating interest rates. Okay. In this, we have identified already. And after identifying, you need to tell them that they are giving a terminology to this. This is an interest rate sensitive. asset slash liability. I hope it is clear. Whatever asset and liabilities basis the floating rate, you term that as interest rate sensitive asset or liability. You can identify them and actually say that whatever is the changes in interest, that will only impact those assets and liabilities. And hence that is called as gap exposure. Now there are three steps that they say. Okay, before that, we also need to know that in case of liabilities and in case of assets, in case of liabilities, we pay interest. In case of assets, we actually earn interest, correct? We earn interest, and in case of liabilities, we pay interest. Now, if you see what is the net interest income, net interest income will be your interest income on assets minus interest expense. I hope most of you know this. So net interest income is netting off your interest expense from your interest income. Now to identify gap exposure, there are certain steps. Step 1. This is for identifying gap exposure. So step 1 says that determine interest rate sensitive assets slash liabilities. Okay. Yes, Nakul, I am covering that. Now I'm coming and relating everything to the meaning of gap exposure. Okay. You will understand in just next 2 minutes. So first of all, they say that determine interest rate sensitive assets or liabilities from the balance sheet of a company. Now let's say I have already identified this is IRS A, IRS L. It is, let's say, 6 crore and it is only, let's say, 3 crore. The liabilities are lesser and the assets are higher. Then step 2, it asks us to calculate gap. Now, how to calculate gap? Gap is nothing but your IRS A minus IRS L. This is called as gap, correct? IRS interest rate, only those assets and liabilities which are impacted by the floating interest rates. So this becomes 6 crore minus 3 crore. Correct? And let's say, correct. So this is the gap. Then it can be said that gap, there can be two situations that can arise. Gap can be positive or it can be negative also. Correct? Gap, when will be gap positive? Once assets are higher than liabilities. When it will be negative? Liabilities are higher than assets. Correct? So the gap exposure says that once you are able to identify what all your assets and liabilities are related to floating interest and you calculate gap, which is the difference between them, then you have to analyze whether that gap is positive or negative. If that gap is positive, that means you have higher assets which are related to floating interest rate and lower liabilities which are related to floating interest rate, and vice versa in case of negative. So it concludes the last point. It says that if in this case the interest increases, then net interest income that we just now saw above will also increase, because the higher interest will help you earn higher income of interest on the assets. Correct? And this is actually net interest income. Correct? Net interest income is the interest income minus interest expense that we have studied about. In this case, if interest goes down, NII will also go down. Okay. Then I think now all of you can understand if interest goes up here, so my liability base is higher than the asset base, which are related to the floating interest rate. So don't you think NII, which is the net interest income, will go down because I will have to pay more. If the interest rate goes up, I will have to pay more on my liabilities, which are higher, and I will earn less on my assets, which are lower. Similarly, if interest goes down here, NII will increase. I hope you can see the impact now. So this is what gap exposure, or let's say the gap analysis is. It tells you how to analyze the impact of floating interest rate changes on the related assets and liabilities, and hence what is the impact on net interest income. Okay, students, this is given in the in the study material. You can now relate the entire part through this discussion. Now let's come to another types of risk. The second risk is basis risk. First we have studied, so just to connect it back, we were actually studying types of interest rate risks. First one we studied gap exposure, second one we are studying basis risk. Now this basis risk, first of all, I think all of you would know what is basis. Basis points, we always keep on saying 100 basis points is equal to 1%. 10 basis points is equal to 0.10%. Correct? So now you can, understand with, if you go through any of the reports where basis points is mentioned, you can easily convert into percentage. I hope most of you would already know it. So this basis terminology is actually has something to do with this only. So it says that in gap exposure, or let's say in any analysis, we safely assume that if interest rate is going up by 10%, correct, then all your IRS A and IRS L would also go up by 10%. The interest related adjustments in those both assets and liabilities would also happen at the same magnitude. But in reality, that is not the case, because in reality, there is different magnitude of changes vis-a-vis whatever the interest rate has changed. For example, some of the assets might not see a 10% increase. Some of them might see a 9% or even 11% increase. Some of the liabilities might also not see a 10% increase because of this 10% change. It might be 9% or 11% because there are a lot of other market factors as well. Okay. So just to cut long story short here, so I'm just putting a very layman language. So interest rate of different items, which is I am saying assets and liabilities here, will change in different magnitude. Correct? The magnitude or the impact of change would be different. It won't be same across. In a response to changes in interest rates. Let's say in response to changes in market interest rates, we can say. If the market interest rate changes, it will not have the same impact and magnitude on those instruments. Yes, Mansha, Treasury Department deals with the interest rate risk management. That's true. So gap exposure meaning we have covered. Perfect. Now let's go to the third type of risk, which is embedded option risk. So please students understand that whatever topics we are covering, everything is linked. And everything is not only linked to the topic that we are studying, but even linked to the previous topics that you have studied and some of the future topics that you are going to study, even in interest rate risk management and beyond. So pay your 100% attention. So in embedded option risks, what does this concept says is, let us try to understand with a instrument called callable bonds. Okay. Callable bonds are those where the issuer have a right to call back those bonds at any point of time before maturity and pay the amount to the holder. Let's say the tenure is 5 years for bond. The issuer will say that I have a right to call upon all the bonds from you, and let's say in 2 years, 3 years, whenever I want, and I will pay you off the money, whatever is the money till that time, and then we will cancel the bonds. So I'm just writing here bonds which comes with a condition that it would be purchased back by the issuer before maturity. Because definitely on maturity, though, it will have to happen. But before maturity, if there is a right with the issuer, that is called as callable bond, because it can be called at any point of time. Now, essentially, from your derivative, or let's say from your earlier knowledge, we can say that callable bonds have two features. One is it is a straight bond. Assume that there is a straight bond of 5 years, which would be paid on maturity, and there is a call option on that bond. Call option is with whom? Call option is with the issuer, because there is a right with issuer to call the bond before maturity, correct? Hence, there is a call option with bond. Who is the call option holder here? Call option holder is the issuer of that bond. Now, in this case, why I have used this callable bond to explain the embedded option risk is, this call option is embedded into the straight bond, correct? That is why it is called as callable bond. Now here is a risk. Now let us relate to the risk. Why there is a risk? Because let's say I am holding a callable bond. And that callable bond to me is issued by A Limited. Okay. Now A Limited will ask me at any point of time before maturity to surrender that bond to A Limited, and A Limited will pay me the money up to that date. Now, if that is the case, then there is a risk. I might not earn the interest rate for the balance period up to the maturity whenever I'm surrendering the bond. Correct? So the risk is that if this call option is exercised before the maturity by the issuer, then it would lead to changes in the interest rate amounts, or let's say the changes in the interest rate percentages. Correct? So if call option is exercised before maturity, then it will impact interest payments, correct? Definitely it will impact interest payments, and from both issuer and from the holder's standpoint. So Manisha, we will come to that. How can futures and options can be treated as a hedge for interest rate risk management? That we will cover in the next, you can say next part of the session itself. Okay. So I think this is clear. So embedded option risk, we can understand it from this, and then you can, again relate to the discussion that is given under the study material. Then comes yield curve risk. Very, very, very important in practical life. One of the great, I would say, economists had given 2008 recession basis this yield curve concept. He had already predicted that in 2008 that recession is going to come basis this yield curve risk. So what does this concept says? There is this called interest rate, right? Interest rates are plotted on y-axis. Let's say here it is 0%, then it will, let's say 5, 10, 15, whatever is the interval. So the idea is that it is going up like this. And here is the maturity. By maturity here, there is a time period. Correct? Let's say 1 year, 2 year, 3 year. I am saying this is in years. So the general tendency is that this yield curve is positively sloped. What is this yield curve? Now I'll explain. Positively sloped. So this yield curve, it says that if you invest in an instrument which has a higher maturity, you will tend to get higher interest rate. Now imagine, let's say there is an instrument which has a 10 years of maturity, which is, let's say here, you will earn interest rate, let's say of 20%. But if you are only investing in a 3 years maturity, you will earn lesser. Let's say you are earning here 13%. This is a general tendency, and this is the general market also. At any point of time, you can go and check what is the yield curve for any particular economy. And it also says that there are good long-term objectives to invest. Because if I'm investing for 10 years, I will get higher return. Simple. So we say that lower maturity, lower yield. Higher maturity, higher yield. Correct. And this you would have seen, let's say if you see a bond of 3 days and a bond of 3 or let's say 30 years, definitely this bond will have higher interest and this bond will have lower interest. Correct? When the yield curve becomes like this, this is actually alarming for a particular economy. It should not be negative, because now here, if you see what is the expectation or what is the outlook in market, market is saying if you invest in 10 years bond, you will get only 5%, but you invest now for 1 year bond, you will get, let's say 20%, which is wrong. Why? Because then investor don't have a long-term objective of investment in that particular economy, and hence the economy is going to go down because investor is expecting that in future the return are going to be less. Okay. So this is again a type of risk. This is called as yield curve risk. In which direction the yield curve will move will determine the interest rate cycle again for that particular economy, and it is going to impact your interest rate risk. Okay. Now next one is actually price risk. Okay, there is one more thing that I wanted to cover in this, with which there is a question also. So I'm just introducing that topic now, but again we will touch it back while we will do that concept. So continuing in this yield curve risk itself, okay, so there are two terms we need to understand. One is the overnight return, or let's say overnight yield, I can say. overnight yield. And second one is, let's say, 6 months, 3 months. It's not overnight. So by overnight yield, I mean that if you invest for one day, what is the return that you are getting? If you invest for 6 months, 3 months, then what is the return that you are getting? Correct? So generally, it is seen that overnight yield is always the risk-free yield, because it is very difficult for the investor to assume that to whomsoever it is lending the money, that person will go bankrupt in one day. And if there is any risk of non-payment. Now, again, I am going back to the first part that I discussed, that interest is because of two things. One is risk of non-payment, and second is time value of money. So in this one day overnight yield, the risk of non-payment is very negligible, because one day no one can assume that the other person will go bankrupt, and hence there is a risk of non-payment. Only thing would be time value of money. So this is a pure indicator of time value of money for one day. But if the interest rate is for, let's say, 6 months maturity, 3 months maturity, it will be your representative of both risk and time value of money. The difference between these two we call as spread. I'm let's say assuming here as MIBOR, which is Mumbai Interbank offered rate. Okay, so let's say MIBOR minus overnight rate, and I'm saying let's say MIBOR of 6 months, and here overnight rate is for definitely one day, is equal to spread. This is called as spread in the market, and that's what we have just seen now. This should always be positive, because it is always positively sloped, correct? Lower maturity, lower interest, higher maturity, higher interest. That is again linked to this yield curve risk analysis. Yes, Nakul, second graph shows recession. This is recession. Yield versus return. Again, Mancha, there is no big difference. Yield is generally accounting for a lot of factors. Return is a layman thing that we say. Okay. But practically there is no differences between both of them. Now let's come to the next one, price risk. This is fifth one, I think. Price risk. So we all have studied already that the bond's price is always inversely proportional to the interest rate changes. If interest rate goes up, bond price goes down, and vice versa. We will again touch back this is in one of the questions while we will solve. Reinvestment risk. I think this is very easy to understand. Reinvestment risk is, let's say I am standing on zero and I have invested for any security which is going to give me return after 1 year at the rate of 10%. I invest 100 rupees, I will get 110. Now, standing here, I would again invest it for another 1 year, which will make a horizon of 2 years. But I might not get 10% here, I might get 9% here, or I might also get 11%. So the reinvestment will not happen at the same rate. Hence, there is a reinvestment risk in case you are taking short amounts. Seventh, net interest position risk. This is something that we have already studied in our gap exposure, because net interest income was what? We said that net interest income is the interest income minus interest expense. Correct, students? If interest goes up, then net interest will also go up only in case where assets were higher than liabilities, right? Then only it has a direct relation. Otherwise, we also said that once interest goes up, then NII will go down in case liabilities are higher than assets. If interest rate goes down, then NII will go up. Both these logics we have already studied. This was what we studied in the in the gap exposure as well, but the same thing with the overall assets and liabilities is covered here, that what is the net interest position risk. No, Mancha, here spread is not profit. Please don't confuse this with profit. Spread is something which is the difference here. You can easily understand that it is a difference here. Okay. Now with this, we actually cover the types of interest rate risks. Now I'm just pausing for 2 minutes and I'm just rewinding what we discussed, because this now the next part of session would be next level of criticality. So hence, first of all, we studied that what is an interest rate, why there is an interest rate that needs to be paid, because of two things. One is risk and second is inflation. So here we are talking about the risk within that security. Okay, this risk has nothing to do with this risk. This risk is of the non-payment of that holder, which is governed by the credit rating, or let's say the credit agencies that give the credit rating. Inflation, we know that it is the time value of money. Hence, there is an interest rate, and we said that interest rate keeps on changing because of the economy, because of the market. So there is a risk. Risk is always there on the balance sheet as well as the P&L, because your balance sheet valuation will go up or down, both assets and liabilities, and your net interest income will also go for a change in case of interest rate changes. Now let's cover the management part. Now, as professionals, or let's say as finance professionals, we are expected to mitigate any sort of risks that a company might have on the asset, on the balance sheet and P&L on account of interest rate changes. Now, what are the techniques to do that? We will cover those techniques now. Let's try to see what all things we will cover. Hedging, interest rate risk. So all the techniques we can actually bucket under two things, under let's say two categorization. One is traditional method and second one is modern method. This is just a classification to say that some things we are following for long and some things we have started recently, or let's say after the traditional methods. Traditional methods, we have two things to study. One is the assets and liability method. Which is also called as ALM. If some of you are doing articleship and doing the audits for banks, you would always be aware, or let's say NBFCs, you would all know about ALM, asset liability management, because there is a ALM report also that gets submitted to RBI by all the banks and NBFCs, and it is very critical from that angle. Second is forward rate agreements. These are called as FRAs. Very, very important and very practical topic. So we will cover what is the meaning of FRAs, forward rate agreements. Coming to modern methods, I am actually writing here because there are three of them. First is interest rate futures. We call them as IRF. Second is interest rate guarantee or option. Interest rate option or interest rate guarantee, whichever name you want to call. Last one is swaps. These are called as interest rate swaps. Let me tell you, all these things are used practically by all the organizations. Very, very relevant topic. Okay. We will cover each and every technique in detail. So first, let's start with the easiest one. So we will go in the order itself: 1, 2, 3, 4, and 5. Okay. Let's start with the first technique, which is ALM, Asset Liability Management. Yes, Mancha, that US bank we will try to discuss, and I will try to tell you what is the exactly thing that has happened and where their interest rate risk management has gone wrong. Okay. Yes. So let's come back. We said that what is ALM? ALM is the asset liability management. So the principle is very simple. If you understand that for any business, whether it is bank or non-bank, cash flows are really important, and timing of those cash flows are equally important. Because if you understand that today the money is needed for some expansion or some sourcing, but if the money is not being available, or let's say the funds are not available, then there will be an impact. Because what will bank do, or let's say what will that organization do? Organization would go outside, borrow funds, pay interest cost, and then fulfill the needs. However, 2 months from now, the funds were automatically getting coming because of the assets that we are going to realize. So there is a mismatch, correct? Because today I need funds, but I have maturity of some assets 2 months from now, 6 months from now, or whatever it is. So the timing of cash flows is very important. What if I could have managed the liability maturity with the asset maturity, the timing I could have managed, then there is no need to go outside and have higher cost of debt, borrow something, and then fulfill my objectives. That is one way of management only, right? So this is very simple. It is just to match the timing of cash inflows and cash outflows. In other words, it is basically matching the assets maturity with the liabilities maturity. Okay. Whenever your assets are going to mature, you need to match with your liabilities maturity, so that there is no other intervention, or there is no temporary need to invest somewhere or temporary need to borrow from somewhere. So this is it. I think ALM as a concept is this only. Now let's come to forward rate agreements. So first, like we borrow from bank, similarly, if bank and that other, so that bank will go to some market in which the other banks can also participate for lending and borrowing, that is called as interbank market. For example, MIBOR. MIBOR, correct, which we already discussed. This is called as Mumbai Interbank Offered Rate. Some of you might have heard of LIBOR also, right? LIBOR, we say that. This is actually London Interbank Offered Rate. But this has been, stopped recently. And the reason is because there were some issues with the way this is getting calculated. Now, instead of this, everyone is using SOFR. So this is called as secured overnight financing rate. Now, I mean, the relevant point here is not to understand these terminologies, but to understand that how the market works. So what is, let's say, MIBOR or the earlier LIBOR or the current SOFR is that these are the average rates of all the transactions happening in that interbank market. Now, for example, in Mumbai, whatever borrowings and lending is happening in a particular day for, let's say, 6 months, 3 months, 1 month maturity, 1 year maturity. So these are different maturities, right? And hence these are different products also. So 6 month maturity is one product, 3 months maturity is one product. So whatever lending and borrowing is happening for these different products at whichever rates. So let's say some deals are happening at 10% for the 6 months maturity. Some deals are happening at 12%. Some deals are happening at 8%. So what is the average of that? That average of that is actually published under MIBOR, which is Mumbai Interbank Offered Rate. And that is used as a benchmark rate in many of the other deals that happens in the outside world of interbank market. Okay. Similarly, SOFR also, secured overnight financing rate. In this case also, and this is a US rate. So whatever is that the US banks are dealing within them, so this will be published here. Okay. Now let us understand. So this is the above topic that we discussed is just to understand that how the market works. Bank A, Bank B, there are, let's say, two banks. Bank A is in need of borrowing the funds, but not now. It needs to borrow the funds after 1 month from now. Okay. It has actually estimated its cash flows timing, and it came to know that bank needs to borrow after 1 month for 3 months, rupees 1 lakh rupees. Okay. So today is, let's say, March end. March end, the bank says that I want to borrow something on the April end for 3 months, for May, June, July. Okay. Bank B, it says that it needs to invest after 1 month for 3 months. This is again rupees, 1 lakh rupees is what they are asking to invest. Yes, Nakul. The ALM method helps in reducing the gap exposure. Yes, Mancha, it is the benchmark rate in the Indian financial market, MIBOR. Okay. So Bank B, it says that it needs to invest after 1 month from now for 3 months at 1 lakh. So the relevant terms and conditions are matching for Bank A and Bank B, only that Bank A needs to borrow and Bank B needs to invest. Because Bank B would have some surplus cash 1 month from now, and Bank A would need some deficit to be funded through some borrowing by borrowing 1 lakh rupees. Okay. But students, please note that this is not the current borrowing they're talking about. They're talking about the borrowing or lending to happen in future. That is 1 month from now. So they also know that current interest rates are somewhere 5% per annum. But they know that these current interest rates, since I told you that interest rates are not static, they are dynamic. They will keep on changing. Whatever is interest rate today, it is not true that it will also be 1 month from now, which is the time when they want to execute this transaction. So they say that, okay, let's come to a term called forward rate percentage, and this is 1 month from now. So they say that whatever is going to be the rate in let's say 1 month, we will simply ignore that and let's agree today only that what is the rate at which we are going to borrow and lend to each other. They agree, let's say 6% per annum. So through this chart, we can understand this is the zero where deal is entered. This is 1 month where deal will be executed. Okay. At the rate of 6% per annum. And it will continue for 3 months. So hence it will become 4th month, because from 1st month to 4th month, 3 months will get completed. So these are 3 months. Okay. So what they are saying is that sitting today, which is on the 0th day, they will enter the deal today at 6% per annum and execute that after 1 month. Whatever is the interest rate going to be at that point of time, irrespective of that. This arrangement is called as FRA. This is called as forward rate agreement, because you are entering and you are fixing the percentage today itself. Correct? Why? Because you want to avoid any kind of interest rate risk. Because you are clear today that whatever you want to borrow or invest, when you want to borrow and invest, so the interest rate should also be known to you at this point of time, which is why you enter into an FRA. This FRA is termed as 1/4. This is the terminology how we say that. Why 1? Because the execution will happen after 1st month. And 4 means 4 minus 1 is equal to 3 months maturity. Okay, this is the standard terminology how FRA is quoted. So please remember, 1 will mean that when it will start, and 4 it will mean that by when it will end. And difference of them will give us the tenure, or let's say the time gap for which the FRA would be effective. Now similarly, FRA 3/6, it will mean what? It will start after 3rd month, correct? And tenure will be 3 months, which is 6 minus 3. Similarly, FRA 3/9. So 3rd month it will start, or let's say the execution will happen on 3rd month with a tenure of 6 months, which is 9 minus 3. Yes, Mansha is saying FRA can also be expressed in years. Yes, it can also be expressed in years. So far is for international market. Yes, Mansha. Okay, students. I hope this terminology is clear. So now let's go to the next step. Now imagine from bank A point of view, and simultaneously also imagine from bank B's point of view. On 0th period, they have agreed that the interest rate would be 6% per annum for the deal that has to happen 1 month from now. On the 1st period, as per my above chart, I am saying this one. This is 0th period. This is the first period. Okay. At this point of time, I'm giving some options here. Okay. Option 1, 2, and 3. So in option 1, for the first period, the actual interest rate, let's say, comes out as 8%. Second option, I'm taking lower than the 6%, which is 5.5%. And third option, I'm saying that it remains same. Only these three scenarios can happen. Okay. While you're actually executing the deal on first period, either the actual interest rate would be higher than the agreed interest rate of 6%. It can be lower or it can be same. Correct? Now, understand in case it is higher. Now, let's stick to Bank A first of all. Bank A wants to borrow. And using this deal, Bank A has locked the interest rate at 6%. And as the borrowing is happening at 6%. Now, what if the actual rate goes at 8%? Bank will say that I don't have to worry. The interest rate has gone up. I have to borrow. I don't have to worry because I have this FRA in place using which I can still execute the deal at 6%. And hence, from the market perspective, again, I'm putting 1, 2, and wait. 1, 2, and 3. Correct. So for Bank A in option 1, there will be a 2% gain. The bank will get benefited because bank is borrowing, correct? And the interest rate has gone up. If the interest rate has gone up, bank will actually go and execute this at 6%. And once it gets executed at 6%, bank will say that, okay, from the market perspective, I have gained 2%. Now let's come to the second option. Second option, we say that, let's say the interest rate at the time of execution has gone down to 5.5. Now understand what bank will say. Bank is saying that the interest rate has gone down. I have to borrow. So don't you think bank will lose because bank has lost this opportunity to borrow at 5.5? Because bank is into this FRA and it has to stick to 6%, it cannot reap out any benefit of this 5.5%. In a way, bank will lose 0.5%. It is a loss. Yes, Nakul, 3/9 exercise after 3 months, third month, and end at 9 months for 6 months. Yes. Yes, very good, Kaushiki. Kaushiki is saying that option 1 is good for bank, case 2 is loss for bank. Yes. Third option, it is neutral. Whatever is going into the market, the same is actually factored in the FRA, 6%, 6%, and nothing will change. Now let's imagine from Bank B's point of view. So here we are trying to see gain slash loss assessment from both the bank's point of view. Okay. So in this particular case, Bank B has a FRA to invest at 6%. Now the story will reverse, okay? Because here bank is having an FRA to invest. What if the market interest rate goes up at 8%? Don't you think Bank B has lost this opportunity to invest at 8% by entering into this FRA and locking the rate at 6%? Yes. So there is a loss of 2%. Correct? In this case, the bank is planning to invest after 1 month at 6%, but after 1 month, the interest rate has gone down by 5.5%. So that is where the FRA benefit will come into play because Bank B will say that I have nothing to do with whatever interest rate comes in the market. I am still able to earn 6%, and hence I am earning 0.5 more than what I could have earned. So there is a gain of 0.5 percentage because of this FRA. Third case, it is neutral. Okay. Now let's say bank A. Let's compute the amount of gain or loss. Okay. Option 1. Or let's say not, I'm not putting bank A here. I'm just saying that option 1, what is the amount? Because we have already seen that bank A will gain 2% here and bank B will lose 2% here. Correct. So option 1, we can say that bank A would get 2% and bank B would pay 2%. Now, students, please note that using your derivatives earlier knowledge, please understand that all these adjustments will happen in net. This is a forward. It can also happen in gross, but let's see both gross and net. Whenever question asks you that, adjustment is happening in gross, you can assume gross, otherwise assume net, because it is one kind of derivative only. Interest FRA is one kind of derivative, right? Because here the underlying is the interest rate. Correct. So hence I am adjusting for net here. We will just say that bank A would get 2% more. So 1 lakh, 8% minus 6% into 3 months, whole divided by 1 plus, because this is the value that will accrue after 4 months, right? We have FRA 1 by 4. So if we just keep it here, the value will be calculated at this point of time, this one. But we need value always at this point because this is the settlement date. This is referred to as the settlement date, the beginning of FRA. If nothing is mentioned in the question, always assume beginning of FRA as the settlement date. It is this logic is a bit hard to digest because till now all of you would have seen in the regular derivatives the settlement happens at the maturity of that derivative, correct? But in this particular case, because the interest reset date is always specified in the contract as the beginning when the execution happens, hence we have to calculate the present value of this. So this is the present value. So we are doing present value at the actual rate. Not so this will not happen at 6%. This will always happen at 8%, which is the actual rate, to arrive at the present value. 490.19. Okay, students. So this is the value as on first month. This is what the bank A has to receive from bank B. Case 2, 5.5%. In this case, bank A would lose 0.5%. Bank B would gain 0.5%. The calculation again remains same. 1 lakh into 6% minus 5.5% multiplied by 3 by 12 whole divided by 1 plus 5.5% into 3 by 12. This amount comes as 123.31. So in this case, bank A would pay 123.31 to bank B. Clear? Yes, Kaushiki. Value on the first month, I mean, because this is a FRA of 1 by 4. So what is the value? Because if you only see this numerator, don't go to the denominator. If you only see this numerator, this will throw you the value at the end of fourth month. But we have to take a present value and bring it to the end of first month, which is when the actual deal will execute. Okay. Okay, Nakul, I will repeat the calculation. And Mancha, I think your doubt will also get solved through this. Okay, everyone, please focus here. This is what we have just seen, correct? Zero is when the FRA is entered. First period is when the execution, or let's say the interest rate reset will happen. I will explain this reset also later, but this is the date at which the actual execution will happen of the deal, and it will continue till fourth. Now if I ask you, let's say in first case 2% was the difference, 8% minus 6%. If you calculate this, it will be the value as on fourth month end. Let's say when the 3 months expire after first month, which is the fourth month end, correct? But the actual settlement between banks will happen on this date. So whatever this value, let's say this value is coming as 500, for example. I'm not just calculating it. This value is coming as 500. Okay, let me calculate the exact number only. 1 lakh into 2% into 3 by 12. It's actually 500 only. Okay. So this comes as 500. This 500, if I take a present value here, I will have to divide by 1 plus what is the actual interest rate is 8%, right? We will not divide by the FRA rate. Why? Because FRA is only limited to 1 lakh. It is not covering your present value. So present value will be 8% into 3 by 12. Correct? That is your present value. And whatever this comes, this will be used. Yes, Kaushiki, you are right. After doing this settlement here, we can actually take the market interest and carry the transaction at 8%. That is what the net settlement means, correct? Okay, perfect. Nakul is also saying clear. Kaushiki is also saying okay. Mancha, I hope your doubt is also clear. Perfect. So this is done. Now, what is there next? We'll see. I think I've covered this. Now let's write the formula. Formula to arrive at payoffs is equal to N into RR minus FR into T divided by 1 plus RR T. Okay, this is to arrive at the payoffs at the settlement date, which is the starting of FRA. Again, I'm saying. So here N is equal to notional amount. RR is equal to actual interest rate. In our previous example, it was 8%, 5.5%, and 6%. Three cases we took, right? FR is equal to forward interest rate T is equal to time period, which in our example was 3 months. This in our example was 6%. This in our example was 1 lakh rupees. I hope this is clear till now. Mancha is saying yes, present value is equal to future value divided by 1 plus RNES. Sanjay, okay. Kaushiki, how can we know actual interest on settlement date? That's what Kaushiki, that's what I'm saying. That the that is where this interest reset date means that in the agreement itself, they will say that whatever is the rate appearing on the beginning of execution, that is on the first day, will be applicable to calculate the difference. Okay. They will know, right? Because today also, I will know interest rate what is there as on today for next 3 months. For 3 months maturity, what is the interest rate going on in the market, that I would know. Basis that rate, they will do the execution of this, settlement of this. Okay. So they will know. Okay. No, no, Pashiki, we are not saying that you need to know that what is the rate appearing on the fourth month. No, we are not saying that. What is the rate appearing as on today for a maturity of 3 months? Basis that the settlement is happened. So this 8%, 5.5%, and 6% is the interest rate that is appearing as on first period, as on first month for any borrowing or lending that is to happen for the next 3 months. That we know, right? No, no, no. 1 lakh is not included of 500 interest. No, that is not right. 1 lakh is the notional amount that needs to be borrowed or paid. This is the principal. Okay, Kaushiki? Perfect. Done till here. Now, just to equip all of you with some of the things that might come in question, I'm just writing 2 or 3 things here. Bank A was to do borrowing. Bank B has done lending. This borrowing is also called as purchase FRA. It is also called as long position in FRA. And the logic is if the interest rate goes up, gain will happen. If the interest rate goes down, loss will happen. Correct? That's what we have seen. Because interest rate gone up from 6% to 8%, gain has happened. Please remember, purchase FRA will always be used to denote that the person who is purchasing the FRA is in the borrowing side, is not in the lending side, is in the borrowing side. When we say lending, lending or investing, whichever way you can say, this is called as selling FRA. If question says that bank B is selling FRA, that means you all can understand it needs to invest. And hence the discussion that we did will apply from bank B's angle. It is also called as short position in FRA. And it also says that if interest goes down, then gain will happen. Correct? That's what we have seen. If interest goes up, then loss will happen. Simple. Okay, students. So with this, we complete first part of FRA. Still, there is some other part. So we will cover some of the questions. So let's break for 10 minutes. Now it is 8:30. We will again reconvene at 8:40. let's go to question number 1 from our assignments to understand the concepts that we did till now and solve it. So it says that Messrs. Parker and Company is contemplating to borrow an amount of 60 crores for a period of 3 months in the coming 6 months time from now. Can we write it in our FRA language? FRA, the duration is 3 months and it has to borrow after 6 months from now. So this is FRA 6/9. Correct? The current rate of interest is 9% per annum. They are saying that interest rate as of now is 9% per annum, but it may go up. Now you see, students, the question is indicating you that it is covering the risk of interest rate going up. If there is a risk of interest rate going up, we will definitely follow the bank A strategy in our example that we studied, right? Which is the borrowing of FRA. The company wants to hedge itself against the likely increase in the interest rate. That means we have to purchase the FRA. Simple. The company's bankers quoted an FRA at 9.3% per annum. FRA interest percentage is 9.3% per annum. What will be the final settlement amount? See, the question is asking us to only calculate the settlement amount. If the actual rate of interest after 6 months happens to be 9.6 and 8.8. So they are saying the interest rate settlement has to happen basis the interest rate appearing after 6 months, not after 9 months. Okay, the same thing that we just now studied. So it's always good to have this kind of a chart so that we know that what are the different time periods involved. So 0 to 6 months, nothing will happen. 6 to 9 months, duration of 3 months, the borrowing will happen. Correct? At the end of at the end of 0th period, the FRA percentage agreed is 9.3% per annum. But there are two cases that are given 9.60, 8.80%. Can we not easily find out the settlement amount? Simple, using the same formula. When interest rate on settlement date is 9.60%, then settlement amount would be as follows. What is the principal amount? Principal amount is 60 crores, right? Or let's say the notional amount. 60 crores multiplied by 9.6% is the FRA, 9.6% is the actual interest rate minus FRA rate is 9.30% for 3 months. And take this as a present value so that it comes for 6 months. Correct? After 6th period. So from this to this, we have to come. So simply we are just taking 1 plus 9.60% into 3/12. Simple. So this will come as, this is a gain, correct? This is a gain. Gain will be rupees 0.0439453 crores. Or we can express it in exact rupees also, instead of expressing in crores. Second is 8.8%. In this case, there will be a loss. 60 crore multiplied by 8.80% minus 9.30% for 3 months, whole divided by 1 plus 8.80 percentage into 3 by 12. So in this case, loss will be equal to rupees 73,3855. 7,33,855. Very easy and very simple question. Again, basis the formula that we have discussed, basis the discussion that we have done till now. Okay, students. Let's come to question number 2. TM FinCorp has bought 6 by 9 rupees 100 crore FRA at 5.25 percentage. So first of all, students, just try to understand they have bought. That means they have purchased. Purchased means they are having a long position. Long position means that they are in the borrowing side, not on the lending side. They want to borrow. Okay. And the rate locked is 5.25, for which the execution will happen after 6 months and the duration is 3 months. I hope this single line conveys a lot of things that we have to interpret. On fixing date, reference rate, that is MIBOR, turns out to be as follows. On fixing date means the date on which the settlement is going to happen. So if I put here, now this question is coining a different term, 6 months, 9 months. Here duration is 3 months. So this is called as the fixing date, or settlement date, or interest reset date, whichever date you want to call. Okay. So on this date, so see how the question has been drafted. But do you feel that these two data points has something to do with us? No, right? Because only this 3 months will be used. Why? Because we have a duration. We are standing here. We are standing here. And next 3 months, whatever is the period, we have to compare it with the 5.25. So 5.5 is relevant for us. Now, what is the requirement? Requirement is to compute profit and loss to TM FinCorp in terms of basis points. Now, if you see, we have entered into a long position at 5.25. Actual interest rate is higher. That means we have gained. TM FinCorp has gained. So we can say that since actual interest rate, that is MIBOR, for similar maturity, that is 3 months, turns out to be 5.50 percentage as against the FRA percentage of 5.25. Hence, TM FinCorp would gain by 25 basis points. Now, because the question has asked us to report in basis points, hence I am putting 25 basis points or 0.25 percentage. Sumit, please recheck your answer. So question number 1, Sumit is saying there is something wrong. I would request everyone else also to please recheck this calculation and let me know if there is some issue. So this is simply one. So the denominator, how it will be solved is 9.60 percentage into 3 by 12. 9.6 into 3 divided by 12. 1 will be added as percentage. So the denominator becomes 1.024. If I put it here, 1.024 is the denominator. Numerator is how much? 9.6 minus 9.3 into 3 by 12 multiplied by 60 crores. So the above is 0.045 crore divided by 1.024. It's same only. Sumit, this check at your end. So I have put here what is the numerator and denominator. You can see from here after solving. Just now again I solved it. It is this only. And if you divide this, the answer will be this. Okay. Second, the settlement amount, and it is asking you to assume 360 days in a year. Now, students, this convention of when to use days, when to use months, definitely question will tell you. In this case, question asks us to use 360 days. So we will use 360 days. Okay. So second part, settlement amount. The settlement amount will simply be 100 crore is the notional amount, correct? Yes. Multiplied by 5.50 percentage minus 5.25 percentage multiplied by. Now here, students, question is asking us to use days convention. So we will divide by 360 and multiply it by 90 because it is for 3 months. 1 plus here again we will use the actual rate, correct? So this comes as rupees 616523. This is the gain amount. So we can say profit slash gain to TM FinCorp is equal to rupees 616523. Question number second is also done. Okay, students. So Mansha, I have explained this, why we are taking 5.5. Acha, you are asking here, is it? Because why we are taking 5.5 and ignoring these two is to match the maturity. If you see, our maturity for FRA 6/9, as I told, is 3 months. So you will use a similar MIBOR to compare the amounts, correct? That is why we have used this one. Okay, now let's come to the next part in FRA, which is again very, very important. Valuation of FRA. So till now, students, this FRA always the value was given in question itself. Now in the previous one, it was 5.25 percentage, correct? This FRA value was given, I mean the percentage was given. Now, what is the logic behind this? How will one try to see that this percentage is calculated? So let us assume a FRA of 3/6. I will be taking all of you through this example through which you all will be able to understand. 0, 3, then next actual 6 months where the execution will happen. Okay. So 0 to 3 months, nothing will happen. Then 3 to 6 is where the actual execution or the funds will happen. So as I told you that market have different products. Some products are for 6 months, some products are for 3 months. Likewise, we have all different type of maturity, standard size of maturity in the interbank market. From that, we can understand that what is the 6 months maturity and what is the 3 months maturity. Ideally, whatever is 6 months maturity should be equal to first 3 months maturity and next 3 months maturity. This is where FRA value will come into play, correct? Because standing today, we need to know that after 3 months, at what percentage this will be invested, or let's say this will be lent. Okay. Now let us assume I will solve, or let's say I will put one formula using that it will be crystal clear to all of you. Now we are given that benchmark rate, let's say MIBOR for 6 months is 5%. MIBOR for 3 months is 4%. And you are asked to calculate what is the FRA 3/6 valuation. Can't you do simply? Yes, we can do 1 plus 5% for 6 months should be equal to 1 plus 4% for 3 months multiplied by, because again this will be invested, or let's say this will be borrowed after 3. So 1 plus X percentage into 3/12. This 3 I have assumed to be X percentage there. Yeah, this way. So if you see this equation, you can calculate X, and that X is FRA percentage. Clear? So this X is equal to 5.94%. If market is operating at 5.94% of FRA for 3/6 with 5% as 6 months and 4% as 3 months maturity interest, that means there is no arbitrage possible, because market is at, in that case, what I can say, equilibrium. Okay. But practically it never happens. Using this technique, you have calculated what should be FRA as of today, which is as on 0th day. But what will happen, as I told you, that interest rate keeps on changing within seconds also, right? And there is a demand and supply led impact also that happens on FRA, because if FRA is quoted as 5.94, but I need anything, my risk policy says that anything up to 6 is also okay. So what I will do, I will block a deal at 6% also, so that the market, so that the FRA rate will increase. So I'm not going into that, but what I'm trying to say is that actual will definitely be different. Now, what if in market, the FRA is available at some price else? So I'm taking, let's say, case 1. FRA is available at lower than 5.94. So we have calculated this as a theoretical minimum price. Correct? This is the theoretical minimum price as per the formula. At least this should be the value. But what if FRA is available at less than 5.94? In that case, don't you think that FRA is underpriced? Because in market, it is available at 5.5. However, the workings are saying, the formula is saying that it should be at least 5.94. That means FRA is underpriced. What if anything is underpriced? We all know if any instrument is underpriced, we always buy that, correct? Because it is potentially going to benefit us in future. So if it is underpriced, then we will take a long position in FRA, or I can say we will borrow through FRA. Correct, students, till now? I hope all of you are with me. No, Kaushiki, FRA is not overpriced. Okay, let me actually explain because this is a bit confusing. Assume there is a equity share. Okay, equity share is the best where you can fit in this theory. Now, the fair value of equity share as per the formula that you have computed comes out, let's say 100. But in market, the share is trading at 90. This is fair value. Or I can say formula value to keep things simple. This is formula value 100, fair value 100, formula value, whatever you want to say 100. Market value is 90. Don't you think it is underpriced? Because market it is available cheap. Okay, Kaushiki. Yes, estimated. No, estimated is higher than market. That is why this is underpriced. Okay. Similarly, here the fair value or the formula value is 5.94. In market, it is available at less than 5.94. Hence, it is underpriced. Okay. You can think this through at your, your own thoughts, but it is underpriced. Once it is, yes, Kaushiki, now you are convinced, I think. If it is underpriced, then what we will have to do? I told that we have to borrow through FRA, right? We will take a long position. If anything is underpriced, you will take a long position. You will take buy position in that. 0, 3 months, 6 months. So this is clear that we have to take a borrow FRA here. If you will borrow FRA, that means you will get funds here. Now that funds again, you will borrow 1, borrow 2, and you will invest for 6 months. So now let me explain this entire chain. You are on 0th day. You borrow for 3 months and invest in 6 months. While you will have to repay your borrowing after 3 months for this borrow one, you have already entered into an FRA for 3 to 6. That will cover you for that second borrowing. Okay. So this is the chain that we can see. Borrowing 1 you will do for 3 months. Then again borrowing 2 you will do for another 3 months. That is this FRA 3/6. Let's say you borrow 1 lakh here. Correct. And you have to pay on the maturity of borrow 1 lakh 3,000. For example, I'm saying. So FRA you will enter for 1 lakh 3,000. And then using FRA you will pay 1 lakh 6,000 at the end of 6 months. And what you will do with this 1 lakh initially, you will invest this at the rate 6 months. And here you will get 1 lakh 7,000, for example, through investing. And the difference of this cash flow and this cash flow, which is 1,000, is your arbitrage gain. Okay. Please try to digest it, because if we are borrowing, if FRA has to be borrowed, then at first place for 0 to 3 months also we have to borrow. And whatever amounts comes at 0 point, we have to invest it. Okay. We will do some questions from that. The concept would be crystal clear. Now let's come to case 2, where FRA is available in market at higher than 5.94%. In this case, it is overpriced, because in market, because the real value of that FRA is 5.94, but market is trading that at 6%. So don't you think that FRA is overpriced? Yes, FRA is overpriced. What happens when something is overpriced? That you short sell. So you will take a sell position and you will short sell that FRA, and that means that you will invest through FRA. In case one, you were borrowing through FRA, right? Case one, you were borrowing through FRA. Case two, you will invest through FRA. So the situation will become reverse here. 0, 3, 6. This you have already understood. This is invest. Correct? So here also you need to invest. This is invest 1. This is invest 2. And you will borrow for 6 months. So what is your strategy? You borrow for 6 months, get cash flow here. So the amount will be like this. You borrow for 6 months, invest for 3 months. Then again, you are booked for that FRA and again invest for next 6 months, next 3 months using that FRA. You will again get the same amount of arbitrage here, because why you will get? Because that FRA will give you higher than 5.94 because it is overpriced, right? It is, let's say, 6%. So FRA will give you 6% return either here, which ideally should have been 5.94 in an ideal world. I hope the strategy is clear, how we have to strategize. So Sumit is asking if there can be an arbitrage loss. So arbitrage is basically a sure shot profit. It can never be loss. It can only be loss if your estimates are wrong. If let's say you estimated this 5.94 wrong, then only you will end up into loss. Otherwise, arbitrage means it is a sure shot profit for you. Okay. Let's come to question number 3 to understand it better. Kaushiki, that's what I'm saying. We will understand the entire thing through this question. Okay, we will revise and we will understand it a bit more. Yes, Kaushiki, this is arbitrage gain. So question number 3, it says that following market data is available for spot USD to JPY 116. So they are just giving us a foreign exchange rate between USD and JPY, which is Japanese yen. They're saying what are the deposit rates? USD and JPY, these are the deposit rates, 3 months and 6 months. JPY, it is very less. USD, it is high, 4.5 to 5. So 3 months have 4.5 and 6 months has 5%. Students, please note these are always per annum rates. Okay. Although it is not mentioned, it is per annum rate. Then forward rate agreement for yen is nil. So they are saying yen has nothing to do with forward rate. So that means this part you can just ignore. Nothing is going to be used in question for this. What should be 3 months FRA at 3 months forward? 3 months FRA at 3 months forward. FRA is 3/6. I hope all of you agree with me till here. What are we going to do? 0, 3 and 6. 6 months interest rate is given as 5% per annum. First 3 months interest is given as 4.5% per annum. This is what we have to calculate. This is FRA that we have to calculate, correct? Simple. You know what is the 6 months rate. You know what is the first 3 months rate. Would you not be able to calculate what is from 3rd to 6 months rate? Yes, we can calculate. This is the formula that we have already studied. Let's assume it to be X. Correct? This is X percentage. Okay, I think there till here there is no doubt, because this is the future value of 6 months. This is the future value of first 3 months. Then this is the future value of next 3 months. Simple. I'm just putting it in a very plain language. Okay. So don't you think for FRA, the first 6 months future value should be equal to ultimately first 3 months multiplied by next 3 months future value? FRA 3 by 6 is equal to 5.44% per annum. If you solve the above equation, so X will be 5.44% per annum. Okay, students. So the first part is done. Very easy and very simple. Second part. The 6 and 12 months LIBORs are 5% and 6.5%. See, 6 months, so they have already given, but still they are telling us again 5%, 6.5%. This is for 6 months. This is for 12 months. A bank is quoting 6 by 12 USD FRA. So FRA 6 by 12 is being quoted by bank at this rate. So 6.5 minus 6.75. What is the relevance of this? I think all of you would have studied in your earlier sessions. This is called as buy rate and sell rate. If anyone wants to buy FRA, bank will give 6.75. Bank will assume the transaction price at 6.75. But if anyone wants to sell FRA to bank, bank will say that, okay, you can sell it to me at 6.5. Okay. Because why I'm saying buying is 6.75, because buying FRA means I want to borrow. Bank will say that if you want to borrow, you will have to give me 6.75% as interest. 6.5 will mean I want to sell FRA to bank. That means I will get an interest of 6.5 from bank. Whichever way you want to think. Okay. So Kaushiki is asking, why are we multiplying by 3 months? Because Kaushiki, this 4.5 will expire after 3 months here. From here, another interest rate of X percentage will apply, which is the FRA which we are valuing. Okay. So that is why first we are coming from 0 to third month, and then from third month to 6 months we are coming, and we are equating that with whatever is the 6 months value. Okay. Then what is the question saying? Is there arbitrage opportunity available? That's what the question is saying. For doing any sort of arbitrage, first of all, we need to know that what is the theoretical minimum price. So first of all, we have to calculate which is the value, what is the value of FRA 6 by 12. In a similar fashion, we can calculate the using the above formula. 1 plus what is the 12 months interest rate? 6.5, right? 6.5% into 12 divided by 12 is equal to 1 plus what is the 6 months, first 6 months rate? 5% into 6 by 12. 1 plus, I'm assuming the next 6 months rate as X. Correct? So here, X, if we calculate, it comes as 7.80% per annum. If in this world, nothing changes, FRA is quoted at 7.8%, there is no arbitrage possible. Why? Because no one can borrow or invest at some other rates. Correct? Because if someone wants to borrow for 12 months, they will borrow at 6.5%. Then they will invest for first 6 months at 5%. and next 6 months is 7.8%. So the return will be equal in both the cases. You're getting my point? Hence, there is no arbitrage opportunity available at this price. That's why this is called as theoretical minimum price or fair value, or you can say the value of FRA, whatever we have calculated. Now, what is bank quoting? Bank is quoting 6.5% to 6.75%. Now, this already 7.8 is higher than both these values. Correct? It is already higher. So don't you think that bank's FRA is underpriced? Yes, because bank is quoting a lesser percentage. So bank's FRA is underpriced. Correct? What we have to do if the asset is, or let's say if anything is underpriced, we have to take a long position. We have to buy that FRA. If we are going to buy that FRA, that means we are going to borrow using FRA. Correct? If we are going to borrow through FRA, then what rate bank would apply? Because bank is giving us two rates. One is the sell FRA rate and second one is the buy FRA rate. Since we are going to buy the FRA rate, hence this rate would be applicable. So now let's frame what is needed. Yes, arbitrage opportunity is available as the FRA 6/12 USD, the one with USD quoted by bank is at 6.75%. Correct? And theoretical minimum price is at 7.8% per annum. Correct? So what is our strategy in this case? Since we are going to borrow through FRA, that means we will have to invest through the other leg. Let's put our strategy here. 0, 6, 12. So this is clear. We are going to borrow. This step we are going to borrow. Since we are borrowing here, we also need to borrow here. Why? Because whatever proceeds will come here will be used to repay the proceeds of borrowing 1. Correct? Whatever borrow 2 will give us on the 6th month, we will use those proceeds to repay the maturity value of borrowing 1. Okay? And whatever borrowing 1 we will get proceeds at the 0th period, we will use that and invest for 12 months. No, Mansha, please correct your understanding on arbitrage. It is not taking advantage of short-term position to long-term. I would not say that. Okay. It is apparently, as I told, that arbitrage is the sure shot profit. That happens because of some gaps in the market. Simple. Okay. So let's come back here. So this is our strategy. We have pinned down our strategy, which is invest for 12 months by borrowing through FRA for 6 to 12. And then again, you have to borrow for the first 6 months. So you will invest at what rate? 6.5%. You will borrow at what rate? 5%. And the FRA is quoted at 6.75%. So you will borrow at 6.75%. Now the last step is just to calculate the arbitrage gain or loss, that we can do it easily. So after 12 months, let's say after 12 months, now let's calculate what is the gain or loss, correct? Simple. So first of all, you will get cash flow from investment. We can assume that 1 lakh is the amount here. Although I think it is not given in the question. Yes, it is not given. So assume that notional amount is 1 lakh. On this 1 lakh only, we will do the calculation. So what you will do at the 0th period, you will borrow 1 lakh for first 6 months and invest that 1 lakh for 12 months. So after 12 months, you will get first of all cash flow from your investment, which is 1 lakh into 6.5% plus 1 lakh. This is what you will get after the 12 months, correct? This is the first leg. So you will get in totality 1,06,500. This is what you will get. Okay. Minus cash outflow from borrowings. How will this happen? It will happen why? Because the 1 lakh rupees that we have borrowed. So first 6 months, the interest rate would be 5%, 6 by 12. And the next 6 months, it will be 1 plus 6.75%. Simple. So 1 lakh, first 6 months, this is the rate. Next 6 months, this is the rate. This is borrow 1. This is borrow 2 through FRA. This will give us the maturity value after 12 months, which is 105,959. This we will reduce. So if this is A and this is B, A minus B is your arbitrage gain. 541. Here we can say dollars because this is a dollar rate, right? So we have assumed here these are 1 lakh dollars. Simple. Now Sumit is asking a good question. What if X is 6.6%? Now students, if you see, let's analyze. I will come to this. Let me just project this for 30 seconds more so that everyone can write down. Perfect, Kaushiki. Now, arbitrage. Now the question from Sumit is, what if theoretical minimum price is 6.6%? Okay. By FRA, what is the quote that bank has given? 6.75%. Sell FRA, what is the quote given by bank? 6.5%, correct? I hope I have written it correct. 6.5 to 6.75, yes. However, the theoretical minimum price, let's say X that we have calculated comes as 6.6. Now, first of all, let us see the buy FRA position. Theoretical minimum price is giving you 6.6. Okay. Your FRA is 6.75. For buying purposes, would you buy? No. You won't buy that FRA, correct? Similarly, the theoretical minimum price is 6.6 here. However, the selling FRA, that means the investment return that you will get, because selling FRA is the investment position. you will get is 6.5. Will you sell the FRA? No. That means there is no arbitrage opportunity here, because it is neither underpriced nor overpriced. Okay. I hope, Sumit, you got my answer. Let's come forward to the interest rate future. So this is what about the FRAs was interest rate forwards, or we can say forward rate agreements. Now let's come to the third technique, interest rate futures. This is called as IRF. So the concept of interest rate futures is, in our price risk, we studied that bonds price is inversely related to interest rate changes. Correct? Perfect, Sumit. Thank you. So bonds price is inversely related to interest rate changes. That is what we have studied. If interest rate goes up, bond prices goes down. If interest rate goes down, bond prices goes up. And this, I think you would have already studied in your previous sessions on the bond valuation. Correct? So I'm not telling you the reason, but this is a normal phenomena. Now, what happens if you want to hedge against the risk of interest rate going up? Can I say that you can hedge against the bond prices going down? Correct? Because it is one and the same thing. If you are, let's say, covering up, or let's say you are hedging against the risk of interest rate going up, using the bond prices, you can hedge against the bond prices going down, because both of them are inversely proportional. So I can say that interest rate, if it is going up, then bond price, or let's say the bonds, it is recommended to short sell. Correct? Because we will benefit through short selling of bond once the prices of bond goes down, and in a way we are hedging the higher interest rate. In case interest rate goes down, better to take a long position in bond market. See, what will happen with the long position in bond market? Whenever bond prices will go up, you will gain. Correct? You will gain through this position. And when will bond prices go up? When the interest rates will go down. Correct? When the market interest rates will go down, then only bond prices. So hence, you are actually covering up for the interest rates going down by taking a long position in bond market. I hope this is clear. Now let's go to question number 4 to understand this better. This is again a very good question. Electra Space is a consumer electronics wholesaler. The business of the firm is highly seasonal in nature. In 6 months of a year, firm has huge cash deposits. Please understand the problem of this company. The problem of this company is there is no ALM. There is no asset liability. Entire asset liability is mismatched. The timing of cash flow is such that first 6 months, they have a huge cash deposits, and the next 6 months, which is especially near the Christmas time and other 6 months, firm cash crunch. There is a need of cash in the company, leading to borrowing of money to cover up for its exposures for running the business. So first 6 months, they are having excess cash. Next 6 months, they are having deficit cash, which they cover up by borrowing. It is expected that firm shall borrow a sum of euro 50 million for the entire period of slack season. Slack season is that 6 months where the cash deficit is there. Okay. In about 3 months. Simple. So they are saying the slack season is going to come 3 months from now for next 6 months, and they can borrow the entire sum of euro 50 million that is needed. So what are we talking about? We are talking about this. We are here 3 months after now, the slack season will start where the cash deficit is there. Here deficit is there. Okay. And hence our FRA will be 3/9. Okay, students. Now let's read further. A bank has given the following quotations: spot 3/6, 3/9. They have given 3 quotations. Spot if you want to say, if you want to invest or borrow, this is the number. 3/6 FRA, 3/9 FRA. It also says that there is a 3 months 50,000 future contract maturing in period of 3 months is quoted at 94.15. So the 3 months tenure future contract that is going to expire is also quoted. You are required to determine how an FRA shall be useful if the actual interest rate after 3 months turns out to be this and this. So students, this line I will come later and I will explain while we will solve the B part. Let us first solve the A part. A part is very simple. It is saying FRA. It's saying FRA shall be useful if the actual interest rate after 3 months, that is the reset date here, it turns out to be 4.5 or 6.5%. They have given you 2 options. What if this comes out to this? So first of all, students, basis the case study that is given in the first para, we know that FRA 3/9 is relevant and they have to buy FRA. So can we say that basis facts given in the question, Electra space need to borrow euro 50 million through FRA 3/9 at the rate of, what is the rate applicable? 5.94, correct? Because FRA 3/9 rate would be applicable as 5.94 at the rate 5.94%. Basis this, we can calculation of gain/loss on 3rd month, basically. Not on 3rd month, we can say that overall this is the gain or loss. Okay. So here it is. There are 2 that are given, 4.5, 6.5%. The FRA is purchased at what rate? 5.94. Because as I explained to you, the 2 values that are given by the bank, we have to take the higher value because bank will sell anything to us at higher value, which is 5.94. And here also it is 5.94. Since we have taken a long position, the interest rate has gone down from 5.94 to 4.5 in the first case. Hence, there is a loss. 1.44%. In this case, it has gone up from 5.94 to 6.5. Hence, there is a gain of 0.56%. So the FRA settlements will be how much? 1.44%, which is the loss for 50 million euro for 6 months. Here it is a gain 50 million euros for 6 months. Okay. I'm not using the other formula because we are just calculating the gain or loss. That's all overall. So 3,60,000 is the loss here and 1,40,000 is the gain here. This is the 50 million euro, right? So we have converted 50 million into absolute euros. So this is the incremental adjustment. Then they will also have to pay interest payment on 50 million borrowings. Correct? So how much they will pay? In first case, it will be actual rate, which is 4.5 into 50 into 6 by 12. Here it will be 6.5 into 50 into 6 by 12. So this comes as 1125,000, 16,25,000. We will add these two, right? The FRA payment settlement and this interest payment, if we add, it comes as 1485 in both the scenarios. That means what? That means by entering into FRA, we have hedged against the risk of interest rate going up or down both. Because the net cash outflow would be same, right? By entering into FRA, the rate of 5.94% is committed, which can also be proved like this. 1485 lakhs divided by 50 million euros is what we have to see into 100 divided into 12 by 6. If you see, it is coming as 5.94% per annum. This is just a cross reference because 1485 is the interest for 6 months. That divided by 50 million for per annum rate, we have multiplied 12 by 6. So this comes as 5.94%. Yes, Sumit, slack season means the other 6 months where sales are not happening and there is a need of cash flow. Clear, students, till now? So till now, we have seen that how FRA has locked the rate of interest because incremental payment will happen basis the loss that we computed, loss or gain that we computed, and the actual interest rate will happen basis the actual rate that is appearing. Ultimately, it will lead to the same percentage. Now, let us go and understand this line, what is mentioned here. How 3 months future contract shall be useful for the company if the interest rate turns out to be mentioned in part A above. Now they are saying you have solved your question using FRA. Now you solve your question using 3 months futures, assuming that the actual interest rate turns out to these two options, which is 4.5 and 6.5. Now students, please note, first of all, this statement will help us in assisting the concept that we studied. We said that interest, in case of interest rate futures, we have to use bond market to do the hedging. If you see at what rate bond is quoting 94.15, that means it is quoted at 5.85%. Yes, it is quoted at 5.85%. Because from 100, if you reduce 5.85, you will achieve 94.15. So this is a way to represent. Okay, whenever bond is getting quoted at whatever price, 5.85 is the percentage. But please note that this is a 3 months future for 3 months. But our borrowing period is how much? Is 6 months. Futures are available for 3 months. From your derivatives knowledge, can we say that we can multiply the number of contracts by 2 to arrive at 6 months hedging? Yes, because 3 months hedging cannot achieve 6 months hedging, but if we do twice 3 months, we can achieve 6 months hedging. Correct? I think this you have already studied. So let's come to the solution. We will just simply put this. Before that, we also need to see that whether we are going to short sell the bond or whether we are going to take a long position in bond. Now, students, if you see, we are facing a risk of what? We are facing a risk of higher interest rate. So the risk of higher interest rate gets compensated by short selling the bond. We will short sell the bond at 94.15. So first, sell futures, correct, at 94.15 in both the cases. This we will do today. But how many number of contracts? Number of contracts is determined by. So what is the borrowing amount? 50 million. What is the one future contract lot size? 50,000, correct? 50,000 euro is part of one contract. But we have to multiply it with 2, which is into 6 by 3, because we are targeting 6 months using the instrument of 3 months. This gives us 2000 contracts. So we will have to short sell 2000 contracts at the rate of 94.15 in bonds market so that we can achieve a complete hedge for 50 million borrowing that we need to do after 3 months. Now, second step, we will have to calculate the price of futures after 3 months, correct? Price of futures on settlement, basically. So this will be 100 minus 4.5. This comes how much? 95.5. From where this 4.5 came? Because in the question it is mentioned that the two interest rates, 4.5 and 6.5, are coming from option A itself, right? See, interest rate turns out as mentioned in part A. So this 4.5 and 6.5, okay? And here it will be 100 minus 6.5. 100 minus 6.5 is 93.50. This is the price of futures on settlement. Now let's calculate gain or loss on future settlement. So students, now I think all of you are expert in this. We have short sold future at 94.15. On maturity, the price turns out to be 95.5, which is higher. Don't you think the loss has occurred? Because if you short sell anything, gain will come when the prices goes down, not once the prices comes up. So what is the loss here? 95.5 minus 94.15. So 1.35 is the loss here. Correct? Because the prices has gone up. Now compare this situation. You have short sold anything at 94.15. You have short sold your bonds at 94.15. But your bonds are carrying at a value of 93.5. That means you have gained here. Correct? That means you have gained here. How much you have gained? 94.15 minus 93.50, which is 0.65. Because the prices has gone down and whatever you have short sold, it is helping you in the benefit. Now last part, cash settlement on futures. That we know, right? 1.35 per future for 2000 contracts having 50,000 as lot size multiplied by 3 by 12 because the future was 3 months. I mean, the tenure of that future was 3 months. So here is a loss. It comes as 337,500. Similarly, here 0.65 multiplied by 2000 multiplied by 50,000 multiplied by 3 by 12. Okay. So here there is a gain of 162,500. And let's compute the interest on normal borrowing. This is 50 million multiplied by 4.5% for 6 months. Correct? This is 1125. This is the same number that we have computed above also for proving our calculations in part A. So this is at 6.5%. This comes as 16,25,000. So since this is a loss, this will get added, and this is a gain, it will get reduced from 1625, right? So this will be 1462,500. This is 1462,500. Again, the same cost in both the cases. Here it is how we have calculated 1625,000 minus 162,500. 1125 plus 337,500. Okay, students. Some of you might ask that why have we multiplied here by 3 by 12? Why? Because if you see the amounts that we are taking here, 95.5 is assuming that it is a 1-year bond because I am adjusting 100%, which is 4.5 or 6.5 entirely into the 100. Correct? That means it is a 1-year price of bond, 1-year maturity of bond. That is the price. So in a way, I can say that this is a percentage. Correct? 1.35 and this one, and hence this is getting multiplied by 3 by 12. Perfect. Now let's actually check what is the effective percentage, like we calculated above. Effective percentage 1462,500 divided by 50 million multiplied by 100 into 12 by 6. It comes as 5.85%. Now, can anyone tell me what is this 5.85%? This is the bond price at which we short sold the interest rate future. Okay, students. If you see, it is given as 5.85, right? This one, 5.85. So ultimately, what has happened in futures? Whatever price we short sold the futures, the same price is logged for the interest rate purposes. Like in FRA, the rate was logged as 5.94, which is this. In futures, the interest rate is logged at this value. Yes, Sumit is saying theoretical price. Yes, I mean, in this question, since there is no arbitrage, we can assume 5.85 is as good as theoretical price because that is the price at which the transaction is happening in the market. So, interest rate futures, interest forward rate agreements, these are the two, biggest techniques that are used for the interest rate risk management that has been used. Now, let me say that in derivatives, all of you would have studied forwards, futures, and options, right? Forwards for interest rate risk management, the topic that we studied today, forwards are as good as FRAs. Futures are as good as IRFs, which is the interest rate futures. And options we will be covering in the subsequent session, which is interest rate options or guarantees, by whichever name we want to call. I hope all of you can link this. And just before I end, I just would want to, spend just 2 minutes more on this SVB bank collapse because I just wanted to link this because that entire collapse is because of the interest rate risk mismanagement. Because if you see there, most of the investments were held in bonds. Whatever surplus cash they had, they invested in bonds. Now, US Treasury, which is the central bank of US, right? Like our RBI, US Treasury kept on increasing the interest rates by cycle. So it went up from almost 1% to 4%. I'm just giving you. So because of this, the bonds prices came down. Correct? We have just now studied. I'm just trying to link that concept here. We just now studied higher interest rates leads to lower bond prices. And suddenly what happened? Some depositors came to withdraw money from SVB bank. Now bank has to sell those bonds. While bank has sold those bonds, bank has sold on losses. And those losses wiped out almost 80% value, because of which bank is now not left with money to pay to the depositors. So you see, if the bank would have taken critical measures on interest rate risk management through interest rate futures and interest rate this FRA, then this situation would have not come. Correct? What ideally what should have bank should have done? Either because the risk of interest rate going up was there, correct? So either the bank should have taken FRA, buy FRA, or it should have short sold bond using interest rate future. So this is what they should have done. But yes, I'm just trying to link it with what we have studied. So this brings us towards the end of today's session. I would request CA Ashish sir to now conclude the session with his remarks. Thank you, sir.
Am I audible, Divas?
Yes, sir, you're audible.
Good morning, everyone. The Divas, your session was very excellent because, in fact, I was listening all around the session.
Thank you.
And in the conclusion, when you are talking about this SVB bank, because it is now in a news.
Yes, sir.
And you have explained very in a good manner. Can you switch off your screen in a 2 minutes? Yeah. Okay, students, I am just supplementing to what Divas has discussed about SVB Bank. Actually, there is, since I have taken the topic of bond valuation, in the bond valuation, I have discussed that there is an inverse relationship between value of bond and the prices of the bond. Okay, so that's why this, due to this inverse relationship, as there is a increase in rate of interest, the value of bond will be fall. So
Yes.
this is kind of a, that's why it is also linked with the valuation of the bond. And moreover, it was very, in one newspaper I was reading, some students are, or even some stakeholders are confusing this SVB crisis with the Lehman crisis, Lehman Brothers crisis. Both are different. While SVB is relating to, you can say it is kind of a interest rate risk, purely interest rate risk. As there was a, the Lehman Brothers case is related to basically default risk, because it was default by the borrowers. If I am wrong, so Devas, please correct me.
No, sir, absolutely, sir. This is a learning for me also. I never thought
So,
that way.
yeah, because it was sometimes it is considered, because since it is a hue and cry that it is, we are saying that it is a same situation that is has taken place in 2008.
Yes,
So
sir.
everyone is saying, yeah, okay, Lehman, like it is Lehman Brothers case. No, it is totally different.
Yes,
So
sir.
we have to appreciate that both risks are different. Okay. Now another point I am just supplementing what Devas has discussed. The one student was discussing that inverse yield curve is indication of recession. Very true, better. Why? Because it is a recession. I'm just supplementing the it. Because what happens when the people say, if I am investing money not for the 6 years, I am investing for the 1 year. So it is a kind of case of a invert yield curve. Now what happens? Normally the money, whatever the investor deposits the money, the same money is given to the industries for production. Okay. Now what happens when, because, and always remember, loans are rare. Of course, working capital loans are for the short term, but overall companies take the loan for the long terms.
Yes.
Now in that case, what happens? Now bank may be reluctant to give the loan for the long terms, because ultimately they may say, the investor will come back to us after 1 year, and how we will refund the same. So in that case, what happens? The bank may start charging higher rate or whatever to cover it. So what happens? The industries may not accept that loan. So due to this, they may forego their plan or they may abandon their decision. So due to this, overall there is a chain reaction that the GDP goes down and ultimately economy goes, because if there will be no production, then of course there will be GDP will be less and ultimately economy will go into the recession.
Yes.
So these are all are kind related to, although we are not discussing the GDP etc., because it's not an economic class, but somewhere and some these are interrelated.
Yes, sir.
And one more point I will had, as Devas has quite correctly discussed, there is a demise of LIBOR, if you recall. And there is one article in the student newsletter. I have written this same article, that is how the LIBOR has been now more, because although for the derivative contract it will be continue up to June 2023, but for other new transaction it has been discontinued with effect from the 1 January 22. So that's why I have written one article. You can refer this article from the student newsletter. I think it is a February 2022 issue. From there, you can refer this article. I have mentioned how this, why this shift has taken place, and there are other aspects also. Because earlier there were only one LIBOR, now there are different rate. Because it can be Euribor, it can be Sonar, it can be Sonia. There for different transaction, different currency, there are different rates. And another point I would like to hear, I think there was, you maybe agree with me, that there was one student was asking like FRA, it was relating to years.
Yes.
Okay. But a student, remember one thing, normally in derivatives or the interest rate, you will rarely found that there are any contract in the years. Okay, even in the foreign exchange, maximum quotation are available for the 12 months.
Okay.
Okay. Now, if you have to go beyond this rate here, so generally there are rollover forward contracts are there, but they are rarely used. So normally in FRA, you will find out the most of the questions that are maximum up to only 1 year, that is 12 months. So please try to avoid this for the longer period. These are totally different. It is not a capital budgeting. And because even hedging is done for the short period. Okay, for the long period, you don't know what will be the rate of interest. Even yield curve maybe, of course, yield curve are for the long term also. Treasury bills rates are there. But if you find exactly the yield curves are normally for the up to 1 year only. On that basis, derivative transactions are carried out. So this is one of the important point. Now there is one. I was just seeing the discussion. There is one question that is there a arbitrage loss? Of course, Divas, your answer is correct. Arbitrage can never be a loss. It is always a profitable. Because what happens? Why it is a always profitable? Because you cover your position in advance. Because if you if you does not cover your position in advance, or you let it remain open, then it is not an arbitrage. It becomes speculation. Okay. And moreover, student, I will advise you all, as my every class I advise you all, please don't indulge yourself in any arbitrage practice. Okay, these classes are meant only for the academic purpose. Of course, this knowledge will be used when you will come into the job, then you can do the hedging. But here, please try to avoid any hedging, arbitrage practice and doing trading. These classes are meant only for academic purpose. With this, we are coming to this session. Now, student, you can send your queries to our email ID, sfm-final at the rate. I just writing it again. SF. I'm just writing in capital. You just type it in small. You can send your queries at this email ID if you have any question, or you can contact us as 0120 3045 956. Now, student, please remember, here we can reply your queries, but provided that you should then have your homework. We cannot make you understand the basic that you have studied at your intermediate level, because unless and until your fundamentals are not clear, so we cannot devote that much of time. Of course, if you have any technical query, if you are stuck on any point, that you can discuss with us. And moreover, one very important thing, the points we are advise you to refer our study material. This from our study material, RTP suggested answer. You are free to ask any question on that. With this, we come to the end of the session. Now, our next class will be after 1 or 2 days. That will be as per our schedule. So we shall join you up there, and we shall finish off this topic that day. Thank you, Divas, for sparing your precious time and throwing the light on a very critical topic and important topic of the interest rate risk management.
Thank you, sir, even for your closing remarks also. Actually, those were very wonderful thoughts. Even I, even I now realize that Lehman Brothers is actually for the default risk because of the interest rate risk. You rightly said, sir. Yeah. Thank you for your wonderful thoughts. Thank you.
My pleasure. My pleasure. Okay, students, have a nice day. Revise whatever you had discussed in today's class. Okay, Devas. Thank you. Thank you.
Thank you.
Okay.
Thank you.
Technical team. Yeah, over.